All right. Kyle, how are you, man?
Greg, nice to be here. Thanks for having me.
Dude, thanks for taking the time. Let's do some quick introductions. So, Grigory I am the owner operator of Vesta Preferred, head of the Vesta team, and I have on with me today Kyle Ernst with Stonehaven. Kyle, give the people a little background.
Sure. Again, my name is Kyle Ernst. I'm the president and owner of Stonehaven Mortgage. We are a boutique residential mortgage bank located in Illinois, and we focus on all residential mortgages for up to 4-unit properties.
And Kyle's company and my team, we work hand in hand very closely, our preferred lender. So I talk to you almost daily, in and out with all of my team's loans, my personal client loans. So in regards to like all of my up-to-date mortgage information and what's going on your side of the world, I get most of that information from you. And you shared something with me earlier this week that I was like, we got to get on and start talking about this because nobody's talking about it.
Yeah.
And it is the loan level price adjustment matrix from Fannie Mae. Lots of words, and
we'll try to dumb it down.
Yeah, you're gonna have to do it for me for sure.
Yeah.
It was pretty eye-opening. What's coming down the road for residential mortgages. So what I wanted to do is I wanted to like break down. First off, I'd love to kind of dive into what is Fannie Mae. Everybody knows the name, but like how do they operate in the residential mortgage arena?
Sure. So Fannie Mae and Freddie Mac, they're the federal-backed mortgage companies that guarantee or insure most of the loans, residential loans in the United States, for lenders to go out and sell. So essentially, they're the too big to fail companies that are out there that are insuring all these loans under the conventional loan limit. So that today is $726,200 is the loan limit. So all loans pretty much at that level or lower are pretty much insured or guaranteed by Fannie Mae and Freddie Mac. And those are the two companies that basically set the pricing for what interest rates are today.
Right.
And so, as Greg mentioned, some big things that are coming out that hasn't been talked about yet by any news outlets. It was sent out late last week by Fannie Mae directly. Is that coming up here soon in the next month and a half or so are adjustments to LLPAs, which stands for loan level pricing adjustments. Basically what that is when you hear about paying points for mortgage rates, well, people that have a little less credit might have to pay points in order to get the same rate as somebody that has excellent credit. So essentially that's how mortgage rates are determined.
What is points? Like kind of just,
Yeah, so let's say somebody's buying a $400,000 home and they're putting down 20%, so their loan amount is $320,000. A point or 1 point is 1% of the loan amount. So on a $320,000 loan, 1 point is $3,200 would be the cost for 1 point.
And so the way that, like all things, right, it's risk assessment, right? So a bank looks at every individual borrower and says, all right, they look at this whole kind of smorgasbord of information from credit score, incomes, debts, if they own other property, right? And they say, okay, your risk level is this. And obviously the idea is the least risky people, obviously, the bank wants the loan to, so they're not going to charge a point to, but like the other people that, might have, either lower credit or something that's higher risk, it's like the bank says, okay, we'll loan it to you, but we're going to need to put points towards your loan because of that, right? That's kind of how it works.
And a lot of times, people don't want to pay that much money if they have a little less credit. So instead of paying points, they can also have a higher interest rate and not pay points. So that in these loan level pricing adjustments have always been around, but now they are increasing these adjustments, which is going to cause all buyers and even people refinancing a huge change in what their rates would be today versus what's to come here in the near future.
Right, and like it's not untypical for there's always these like adjustments and things like that has come through. really kind of interested, piqued my curiosity was like, whoa, like we are now talking about people with what we've seen as pristine credit are going to start getting hit with fees, and there's not really a good explanation why.
Yeah, and we'll give some examples here, but like pretty much anybody that has a 740 credit score or higher is considered excellent when it comes to the pricing of loans. So whether you're at 810 FICO score or 760 or 740, those people would get the exact same rate for the exact same cost.
Before, like in the past, right? Up to this point, but now moving forward, which I think this starts May 1st, 2023, right? So any loans that are...
Yeah, it's going to start actually earlier. So the buzz initially is going to be that loans that are transferred to Fannie and Freddie on May 1st or later have to have these new loan level pricing adjustments on it. However, it takes about 30 days from a closing for that loan to be transferred to Fannie Mae or Freddie Mac. So meaning that basically all loans that are closing past March 31st are going to have these loans, have these pricing adjustments, even if a loan is locked and in underwriting and they're locked good through the month of April and they locked prior to April. If they are closing in the month of April, they're going to have these new adjustments affect their interest rate.
So, okay, so March 31st, right? Like we're talking now, it's end of January. So we're talking like, there's like about a 2-month window to like find a place, right? Get it and close on it, which, you know, the window's gonna start closing within the next 30-ish days here for like that to be realistic. Because typically you see most of my contracts are like 45, maybe 60.
We're basically already almost there. 60 days is almost the end of March.
And that's what like blows my mind is that like, you know, everybody, we just came from this like super crazy high interest market where like kept raising, and all of these buyers and everyone I was talking to for the most part was like so nervous, and it created all of this essential panic, right? And like all that doom and gloom being discussed. Now, like the positive is that in the beginning of this year, it kind of feels a little bit more stable, and people are starting to talk about it be stabilizing because inflation is going down, right? So like, going into this year, I was like, all right, awesome, let's get back on our feet. Let's have an amazing year for selling. And then boom, you hit me with this news.
So essentially what we've been waiting for probably for the past 6 months. And Fannie Mae and Freddie Mac have talked about this, the Fed has talked about this. As soon as inflation is combated, and we're already seeing signs that is happening, then interest rates should start to be decreasing. So we're at that moment where it's springtime and early summer where that was anticipated for interest rates to come down. Yeah. Which is why we're starting to see a lot more buyers coming into the market and a lot more sellers starting to get ready to list their properties for sale, because now they can move into a house and not have rates that are in like the 6 and 7%. But now that we're at this point, it's almost like they're going to delay rates that are coming down. People are going to be negatively impacted and not get the lowest market rate because of these adjustments coming out.
It's almost like they're trying to continue that like sluggish real estate market unnecessarily. Obviously I don't work at the government, and there's always reasons behind this stuff, right? It's just like the way that it's not even announced, no one's talking about this. So it's like, why? Like what is going on here? And like the truth is that like this is going to be the next real estate news story, right? Because all of last year was like about increasing interest rates, and now it's like this is essentially the same story. It's just done in a different way, almost unnecessarily. Obviously, like I'm not an economist here, right? So there could be like reasons that I'm not seeing, but what I'm seeing is like people, everyday people, really good. They've been saving, they've been waiting, they're ready to buy. Right. And they just kept getting like gut punched about like all these interest rates. Now they're like, all right, fine, like let's go. I feel a little better about this. And it's going to take them a few months to like most people to feel comfortable with it. And then when they do, boom, it's like, by the way, I have to charge these points to you. I know your credit is pristine, but like, yeah. Now, real quick, before we get into the examples, I do want to go over one thing. This Fannie Mae doesn't charge this directly to consumers, right? They charge it to the banks, right? This is like they underpay by this amount, less per type of loan. But then the bank isn't going to be like, hey, we're going to be really nice about this and just like, give a freebie. They immediately pass it off to the consumer. So it essentially is a direct to consumer fee, basically.
Yeah, it's a pass through directly to the consumer. That's what it comes down to. It's going to affect the consumer. Every single bank, every broker, every mortgage bank, we all go to the same place. It's Fannie and Freddie. It starts there with what the pricing is, and then that gets transferred to the consumer in one way or another.
So, all right, so now we have the picture. Let's show me some examples of like real world impact of what this looks like if they got a loan today, and then like nothing else changes except this goes into play, how much more it's going to cost people.
Absolutely.
You gotta go slow. I'm not the best with numbers here, my man.
All right. So here's a typical example of probably, 50%, if not more, especially first-time home buyers.
Okay.
That are buying in Illinois, in the city, on average, purchase price around $400,000, and they're paying on 10%. Okay. So that creates a loan amount for $360,000. And then here are the main loan level pricing adjustments that are coming into play. So you have somebody with a 7.
Real quick, can you go back to that? Because I just want to go over this example so people understand. So do you have I don't see the this.
Oh, sorry.
All right. Yeah. So okay. You have a $360,000 loan. This specific borrower you're talking about has a 780 plus credit score.
780. This is like one of
the best.
Top 20% best FICO scores you can have.
Yeah. Like you're paying off all of your credit cards. Maybe you got a credit, your credit got pulled like in the last month because you want to get a car, whatever. Your debt to inflation, so you have 41% debt towards your overall holdings, and then 10% down. All right. So now we're gonna dive into, you can kind of go into like how these rates will get changed. Yeah.
So in today's market, in this scenario, person with a low debt ratio, the strongest FICO score you can have, and is putting down 10%. Today, that person would have a 5.875% interest rate.
Okay.
Starting in about a month and a half, without anything changing whatsoever, that same person interest rate would be 3/8 higher at 0.375. So an interest rate of 6.25.
And so just for numbers and cents, right? That means that that mortgage payment went from $2,129 to $2,216
for being one of the strongest applicants.
One of the strongest borrowers that banks should have been like, listen, I want to give you money, just take it because I know you're going to be so careful with it and you're going to pay it all back. Now they're getting hit with essentially $100 more a month, right?
Yeah. Or and again, this is with no points. So essentially, that same person, if they wanted that 5.875%, that would pretty much cost them close to that $3,000 number to pay a point in order to get that rate. So it's either or. You can pay $3,000 for that point to get that rate, or you increase your rate to 6.25. Either way is a no-win situation for this great borrower.
In this purchasing arena, right? Like in this price point, every single dollar matters, right? It doesn't matter what people's credit scores or whatever. When you're buying and you're saving, and the average buyer with me, like $100 a month is a big change, right? And it's big enough to affect buying decisions, right? And that's what my concern is that people are going to come across and being like, it's starting to get too expensive to buy again, which was exactly what was happening last time. And it affects the way that they bid, right? Because then they start asking sellers for more money off the top. Then it affects the seller's ability to sell. Who knows what their holdings are? Then it affects them to then move out of there. Again, we're having the same problems.
Yeah. And then, what you're going to have here coming soon is you're going to have so much confusion for buyers in the marketplace that are trying to seek out loans and reach out to different competitors. And there's going to be a vast array of people getting rates that are, differentiate, within like 1%, from, 6% all the way to 7%. And nobody's going to figure out like, why is there such a difference from talking with different lenders? And some lenders might take a little bit more information in their credit score and that kind of thing. And it might get very granular and give them what it actually is going to be. And for the lenders that are quoting just based, oh, you have great credit and not getting the details, their debt ratio or anything, they're going to give like a 6% rate. So this is going to cause mass confusion for buyers in the marketplace as well.
So real quick, we are, okay, again, like, I don't want to make this all doom and gloom. I do want to know that at the end of this, to stick around, because there is solutions that have been created that Kyle is heading, that is, I'm going to say, a game-changing methodology that more people need to know about now. So I hope people, let's call in a few months, stumble across this, when, like, what is happening, they educate themselves. But again, I'm all about empowering people, right? Giving them the right information and making sure, like, buying a home is a good decision if you have the right tools ahead of you and in front of you, and using everything, because it's still an amazing financial wealth building tool and whatnot. This isn't a fantastic way for the government to assist what they always say, where they're like, the backbone of the US economy are home buyers, right? So, like, why would a government agency start negatively impacting people that have done everything they possibly can to get to a place where they are ready to buy a house, and then boom, it's like, I know you've been for 3 years, no inventory, and like now everything's starting to get better, but hey, let's get you more money to get the American dream. Let's go to a few more examples.
Yeah, so here's going to be an eye-opening example.
Share the screen.
So here's pretty much the exact same example as we had before, as far as debt ratio, got great credit over 740, and actually putting down more money, putting down 15% down versus 10% before. So here we have a client that has 759 credit score. Before it was 740. That has still the same debt ratio, no changes there. And he's actually putting down 85%, 15% total versus 10% in the previous example. Now, if you remember before, in the other example, the credit score went from 5.875 to 6.25. Well, now you take a look at this. This guy's a stronger client, but his credit score is going up to 6.5 as opposed to 6.25. So how does that make sense for somebody that's putting down more money and that has a better credit score, that they are being impacted more negatively than somebody that's putting down less money with the worst credit score?
And it's like, and look at the difference. It's almost $300 a month in difference.
Yeah, and that's, the higher the loan amount becomes, the more negative impact it has on the change in the borrower.
This is going to affect so many different segments of the market, right? Because every single type of buying segment, different types of buyers, it's more money, but then it costs you more money, right? So it's like, it affects everybody in the same-ish way. So these people, I mean, it's gonna be huge.
I mean, look at this last example real quick, going back to the same purchase price. Again, with 20% down, again, even stronger than the first example. They're putting down 20%, not 10%. Everything else is the same. Now your rate's going higher again.
Wow.
So basically what's happening is that Fannie and Freddie have looked at risk and seen where the wheelhouse or the majority of people are buying and where their credit score is at. And they're actually taking money essentially from the clients that actually are stronger than clients that have worse credit and less of a down payment. So
like everything's costing more. Like we're talking about, like, the cost of eggs is a luxury now, right? I mean, it's everything. Yeah, inflation is going down, right? Like by the metrics, but the conversation is that costs don't feel any less, right? People are trying to save money. They're going out less. They're eating at home more. That it's just constricting and contracting this economy. And like the whole idea of a soft landing, right, is to not go into a recession. Everything here is telling me that this is like, okay, cool. Like, let's definitely kickstart a recession, which is, it's just like, it's like a backwards thinking for like what the government is that they want to like what they're actually doing. And I mean, Jerome Powell, like, you know, his whole thing was like he was using real estate as a means to slow the economy, right? So it's like we know that from the way that the Fed was doing this is that, you know, like to slow down home lending was like a way to slow down the inflation. I was like, okay, great. Okay. But like, why would you keep it going when like inflation is definitely already slowing down, and now people, the most important like consumers that help prop up the economy and will definitely get us up into a growth economy, into in an anti-inflation, like to then hit them in the butts with the stuff.
Right. And I think that the positive in this, again, to get away from the doom and gloom, is that because they're coming out with this right now, they are, Fannie and Freddie, they're already anticipating that rates are going to be dropping here in the upcoming months. So
which is backwards of what everybody on the news is talking about. Everybody's saying interest rates are going to go explode. They're going to go high. Yeah. But like, I don't know, they're not. They're actually going down. Like
they're going to come down. It's just that the buyers and borrowers out there that are looking to refinance, they're just not going to feel the benefit like they have in the past because of these new loan level pricing adjustments. So if rates go down to 5%,
right?
Like if it was the same market today, pretty much everybody in that wheelhouse in those examples that we got would all get 5%. Yeah. But now the majority of those are going to be in the mid 5s as opposed to 5. So in order to get that 5%, you got to have 40% equity. You got to have 780 plus FICO score. You got to have lowest DTI. Essentially, you have to have what less than 15% of the people have out there.
Okay, can you bring up the matrix so we can actually kind of take a look and see how the whole thing plays out? Because this is really, really interesting to me.
So here is the matrix, and
it's kind of like explain how what's on the left, what's across the top.
Yeah, so this is just taking in consideration the credit score on the left-hand side. So that these are your tiers. Now these tiers always used to exist, but there never was a tier past 740. These tiers existed, but now they're tiering off greater credit in these 20-point increments. So that's a big change. And then on the top right here, that's your loan to value. So, you know, in this bucket right here, 80 to 85% loan to value, that's what somebody putting down 15% to get to that 85%.
Got it. So left side where you see 0, 0, 0, it's like basically you're putting 70% down. I mean,
exactly. These are like you have a tremendous amount of money that you're putting down, or if you're refinancing, you have a bunch of equity in the house.
Handful of people that even do 50% down, right?
No one, barely anybody.
That kind of cash right now. Nobody.
Yeah. And if people do have that kind of cash, they don't want to put in the house.
In this buying pool, yeah, exactly. So it's like, okay, so what you highlighted is essentially kind of like what the 90% of the buying market.
So the high besides for this is a little outlier. This is just an outlier, but the highlighted part in this area right here is what we consider the wheelhouse, which represents mostly 90% of buyers out there right now that they are buying. And all the green, these are what the loan level pricing adjustments are. So
like what it always was, right? Like, so like, it's not like this isn't new.
Yeah. So the green, so these are what the green are what exists today. Yeah. And the red and highlighted are what those are increasing for.
Like where you're at right now, it's a 0.75 increase. Nothing changes, right? Nothing
changes. Yes. But so, now all of a sudden they're being charged like technically in points, 0.75% is what that would be a charge, or the rate would go up by almost 0.5%.
But like also what's huge is that like just like nothing like above 740 used to exist, right? 760. This whole graph is new.
Right. So like all these adjustments, the old 0.5% adjustment here, 0.5%, these were all the same 740 and higher. But now they're making all these adjustments for up to 759, up to 760. Even with the people that do have a great credit, they're still being negatively impacted.
It's just wow. Like I would love to hear why. Like, where was the decision behind this? And why not more people talking about it?
Yeah, and again, that probably fully won't be disclosed to the public.
Unless they do try, we got to do more of these, man.
Yeah. So we think that, the majority of is that, listen, volume levels are low. We have zero refinancing that have happened, or less than 5% of all transactions are refinances. And all you have is purchases. And we were one of the slowest markets for the past 6 months, real estate, over the past, over a decade. And now we're going into a next phase where inflation should be coming down, therefore mortgage rates should be coming down. But now Fannie and Freddie are going to rake in extra money because of the situation that we're coming into. And it used to be passed to the borrowers, and they get, to have that positive impact with rates coming down. And they still are going to have it, just not as much, because Fannie and Freddie are going to take it off the top and get paid.
Is it like, is the government trying to like fund certain programs through like homeowners and like?
Yeah. Well, behind the scenes, we don't know what's going on, but during COVID, obviously the Fed came in and they were 90% for that 2-year period. They were the ones who were purchasing all the mortgage-backed securities.
Sure.
So maybe this is a way to basically repay that back for all the money that they fronted during the COVID years.
Like, I get it, but also like, that's their job, right? Like at the end of the day, it's, it's like me saying, well, like, I paid a lot of taxes at that time. So like, let me take some of that money back. Like, I definitely like, my taxes aren't going down.
Yeah.
And I don't want to get this into like, government bashing session, but it's at the same time, it's like when this conversation about a recession looming, right? Every step is being so carefully like crafted and discussed. But then it's like, boom, it's like this backwards decision of like affecting the most important buying, pool that props up the economy. All right, so we have that, right? So let's finish this on a positive note.
Yeah.
Tell
So
me about when people are in dire straits and they see this and they're like, oh my God, like how do you see a way for people to?
Yeah. So one of the things that we've always done for our clients is that we try to help their credit out, even while they're under contract and we're in underwriting. If we can get their score from a 730 to a 740, which increases their interest rate by an 8%, then that's something that we do for our clients free of charge. Like, listen, we want you to have the most, the great experience in buying a house, and we're going to try everything that we can to get your credit score up. Well, now that becomes even more evident for even people that have excellent credit. Because if you're at a 779 and you need 1 point, like, listen, we go ahead and we help you pay off, get your credit score up. That could be paying off debt, getting collections removed, something, whatever blemishes that are on your credit. Like, that's kind of what we do. And if you're wanting that lowest rate, and right now it's costing you 1%, well, we can go ahead and work on your credit in the process and get that percent taking off because we increase your credit, or at least lowered, while we're in process. So that's something that is going to be huge for all our clients.
That will be a huge piece of lending this year, right? So if a lender that somebody's working with doesn't either know how to do it, they're not proficient at it, because you guys do it in like 7 to 9 days. I don't even know.
Yeah, even less than that. I mean, typically it's like a 5 business day turnaround. Clients that are out there that are thinking like, oh, I got to get a credit fix agency out there to help me. No. That costs thousands and thousands of dollars. It takes 60 to 90 days, and they don't even do a great job at doing it because of the overwhelming requests that they have. We get things done in like typically, 5 business days to 7 business days on average, sometimes a little longer, sometimes even less. So that's why if you have a 30-day close, like, there's no way I can increase my credit. Well, let's try. And more than likely we can. And then all of a sudden you'll get the benefit. And then all of a sudden your rate will be lower.
So what's the secret sauce? How do you guys do it?
Yeah. So at every single client of ours, we have linked up with the credit bureaus. We can see when we pull their credit, how to improve their credit score. And in most cases, it will tell us exactly to 1 point that we can increase 19 points, or we can increase 33 points. So then we dive in and we say, okay, if we're looking to get 22 points, we have software program that's linked up with the credit bureaus, and we can say, oh, pay this credit card down by $1,710, and it will get 13 points, and we can adjust that and see how much we need to pay down or pay off on a credit card to get the highest potential credit score. So we do that for all of our clients and every single credit report that we pull.
How accurate is it?
It's within a 5-point variance.
Wow.
Which
And
is pretty, and sometimes it comes in higher, but I say 80% of the time it comes in exactly what it said it's going to come in.
And it's like, and the credit bureaus are reacting because they're like, the whole idea is like, we'll call you in 2 months and maybe something will change. This is
in normal turn time, if you pay down a credit card and then they're sending information to credit bureaus, it's a 45 to 60 day, time frame to increase your credit. We have to pay our end, not to the consumer's end, but we go ahead and front that money and pay it for our consumers' behalf. We're trying to have that client help them out as much as possible, so we have them for life. And we do a manual change with the credit bureaus directly, and we pay a fee for that, or we pay a fee for that. We don't pass it on to the client.
Man, it's like people got to know this, man. They got to hear about this because. If
people won't even know about it even when this gets out to the public in the next month. People aren't going to know it and feel it until April comes around.
Everything is reactive, right? And that's what's like, unfortunately, like how this works. And I'm just trying to get people, like we're starting to call people and be like, listen, I know you're on the fence, but like it makes a lot more sense to buy now. Here's why. You have a 60-day window before things.
Oh, 100%. Especially if rates are, they've come down a lot already. They were in the 7% before. Now we're seeing in like the high 5s, low 6s for most people. Well, if those rates don't come down in the next month and a half or 2 months, when these come into effect, talk about the market continuing being slow, because now all of a sudden the market hasn't changed. And all of a sudden the rates are being higher. Well, why is that? Well, it's because of this. So buy now before this takes effect.
Wow. Well, Kyle, I appreciate you, diving into this and going over it. I'm assuming this isn't the last time we're going to talk about this.
Yeah.
So, but I think this is a really good start. And yeah, man, let's keep getting the word out there, man. I appreciate you hopping on.
Trying.
All right, brother. Thank you.
Thanks, Greg.